You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, everyone. Welcome back into the podcast. Another earnings episode today. We've got here come the big dogs, right? In this episode. Here come the big dogs. We got Google, we got Apple, we got Facebook, a couple of other ones maybe we'll get to, maybe we won't. We got MasterCard, Ford, etc. But yeah, this is going to be a full episode, I feel. So anyway, how have you been?
I've been good. I mean, today's episode is certainly going to be jam-packed. It's good to have sort of things like Facebook and Google together because they're kind of similar businesses. But at the same time, when you have all of these big companies at once, we have a bit of a squeeze to try and get through
them all in
as much as possible. But
that's it.
What has happened this week for me? Victoria went into another stage of lockdown. So yeah, things are not really getting any better here. But
no.
Yeah, it's unfortunate.
Yeah, it's really just Victoria at the moment, isn't it? How many cases per day are you guys adding? Or something? It's in the hundreds, isn't it?
Yeah, some days are 300 or 400, some days are 800. So,
but you know, that's crazy because we're like in Australia, we think that like a couple hundred per day is crazy high, and it's like in America, it's like 50,000 new cases a day.
Yeah, I think they had something like 1,000 deaths or something.
That's
one day
insane.
Last
Man,
week.
I feel for him.
Yeah. Not good.
I was listening to a little talk by Bill Gates, and he was just slamming the United States though. He was just saying, we're just not taking this seriously. The policy around the world has been that as infection rates increase, business restrictions, lockdown restrictions get tougher. And in the United States, infection rates are increasing and the lockdown measures are getting more lax. So he literally just basically sat there and said, it's really sad, America, we are not taking this seriously and we are going to get destroyed for it.
Yeah.
It's man, you probably want to listen to Bill Gates. I mean, he's certainly up to speed with all this stuff on the coronavirus with all the foundation work that he's been doing.
Yeah, who knows what's going to happen over the next few months. It seems like it's just out of control in some places like the United States, but I guess we'll see what happens. All right, should we get into today's sponsor?
Yeah, let's do it.
Yeah, so today's episode is sponsored by Sharesight. So Sharesight is an application that I've personally been using over the past few years in order to track the performance of my stock portfolio. And it's really good for keeping track of your capital gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains if you are buying shares internationally or you just hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. And if you use that link, you can also get 4 months free when you sign up to a yearly subscription. And they also have a free plan that you can use forever. So there's no cost to you at all to go check that out. And it might even save you some time or money when it comes to tax time.
Exactly. Thanks, Sharesight. All right, let's get stuck into it.
Yeah.
Where do you want to start? Oh, actually, we should just start quickly just with this news story that it was on the 29th of July, so a little while ago. The US Federal Reserve decided to keep the interest rate at, what is it, like its all-time low, 0 to 0.25% target. And they're saying that, I mean, Jerome Powell, he just keeps saying that we are going to do everything in our power to make sure that that America gets through as unscathed as possible, which is pretty crazy. And it's the primary reason why stocks are going up at the moment.
Yeah, absolutely. I think, in particular, I think the Federal Reserve is very concerned about this possibility of deflation. I think that their ability to control, they have a lot of things that they can use a lot of levers, I guess, that they can use to control inflation, but there's not a whole lot that is available to them in order to control deflation if it really spirals out of control. So one thing that I saw out of this week is that I'm not sure if it's confirmed or anything yet, but it seems as though they're going to be creating a plan over the next few months or so in order to basically continue to print money and buy financial assets and help the government provide stimulus to Americans in order to get inflation going, because there just hasn't been any inflation at all.
That's it. Yeah. Because they've almost bottomed out the interest rate lever to try and stimulate spending in that aspect. So I guess they got to do something else. They got to try and start these new initiatives, try and get money into people's hands and get them buying stuff.
Yeah, exactly right. And it's certainly made, we've seen it over the past 10 years, but we're going to see it in the future as well. It's certainly made a very interesting outcome in the stock market and other asset markets, where basically you have a Federal Reserve that's just printing hundreds of billions of dollars and just literally buying financial assets. It's going to be very challenging to see asset prices fall when you've got this huge just money printer just pumping money into the market. It's going to be fascinating to see what happens in the future, because I think it's quite obvious that there's a lot of stocks in the market that are way overvalued. And
for sure.
Whether we're going to see that reconciled in the short term is, I don't know. We might not see it if this is their plan, just to continue to pump money into the market. But yeah.
And that's the thing. People saying, "Oh yeah, but stocks are so overvalued." But really, how much power does the Federal Reserve have? Like, they actually have a lot of power. Like they're the dudes and they're the guys and girls that are actually controlling this system.
Yeah,
so they can do whatever the hell they want.
And it really does two things when the Federal Reserve comes out and says they're going to continue to do quantitative easing, printing money. It really does two things. One is they're literally buying financial assets, which puts upward pressure. The other thing is just sentiment, right? Everyone thinking, everyone just having the notion and the idea that, if they're continuing to print money, the market can't go down. So therefore, I as an individual or as a investment fund will just continue to buy assets at any prices because the market won't go down. So it does kind of two things. It's the Federal Reserve pumping money into the market, and then everyone else pumping money into the market following the Fed. So
exactly.
Yeah, it's certainly an interesting dynamic.
Yep, and it doesn't look like it's going to stop anytime into the future. No. They are, every opportunity the Fed gets to come out and say we're going to help support the economy, they will come out and say that. So, yeah, who knows?
Yeah,
jeez. They're creating an environment where it's very hard for businesses to fail. So, and that's why stocks would go down a lot. That's why we'd see stock market crashes. If people have reason to believe that these companies are going to fail, that their stock prices are potentially going to go to zero, then we start seeing the stock crashes. But the Fed's just creating an environment where that's just not going to happen. So,
but oh boy, are some businesses, do they seem like they're trying to fail?
Yeah, the amount of
debt they take on in share purchases. No,
they're trying their hardest. Oh dear.
All right.
Anyway, we should probably move on, shouldn't we?
Yeah. I think maybe we'll start with the two big advertising companies, online advertising companies, Google and Facebook. So I'll run through Google first, and we can have a discussion around that, and then we can do a bit of a comparison to Facebook. I have a little bit more to say on Facebook, just because, disclosure, I'm a shareholder of Facebook. So,
me too.
Well, there you go. We'll probably both have a little bit more to say on Facebook. Yeah. But in terms of Google, so their revenue came in at $38.3 billion, which was down 2% year over year. So from the same second quarter of 2019. And I actually read a headline. This was the first decline in their revenue ever in the history of this company. So it's amazing.
That's insane.
It's taken a very severe recession, pandemic, economic environment to cause them to see a drop. And after all of that, The drop was 2%.
Yeah. So basically flat.
Yeah, basically. And it actually was flat on a constant currency basis. So the negative 2% is just currency exchange.
Right.
So, yeah.
There you go.
Very resilient business. We'll just say that. In terms of in terms of, I guess, where some of this revenue came from, I just picked out a couple of lines that I thought were interesting. So revenue from Google search was down to $21.3 billion. So obviously as a percentage of their $38 billion, that's quite a substantial piece. And that decline drove a substantial part of why their revenue was down 2%.
Fell.
Interestingly enough, revenue from YouTube was actually up. And it was actually one of the only categories that was up, along with cloud was also up, and a couple of other smaller components. But I think YouTube was the biggest component that saw an increase, and it went to $3.8 billion in the quarter.
Still not that much versus the rest of their revenue, though.
Tiny piece. What is that? A 1/5 of the size of their Google search, and then 1/10 of the size of their overall revenue. So very small.
It's crazy how much money they make just from their Google search. Like, that is such a core of their business, and that's really the real part of their business that has that huge economic moat. So you just don't see that going, yes, it fell this quarter, but you don't really see that going down in the long term, do you?
No, not really at all. And I think they cited that one of the driving factors is that there was a decline during the period of people searching for, I think they called it commercial search terms or something like that. So in other words, people trying to buy stuff. Exactly. And that, I guess, would cause advertisers to be less inclined to spend on those search terms. So that's kind of what drove that. Interestingly, for the YouTube side of things, brand marketing actually declined. So that's, I guess, big businesses just advertising, getting brand awareness to their business. But the increase was driven by direct response marketing. So those are those ads where they're trying to get you to buy something directly from the ad, basically. There's kind of a call to action. Okay. So you see a lot of these, at least I see a lot of these about, people trying to make money online, for example, selling their courses and that sort of thing. Or
buy this,
or things like, I guess, Robinhood and those kinds of places that are trying to get you to do something, trying to get you to do an action. So go and sign up to their site, deposit $50 or whatever it is to their trading platform. So,
Yeah, as opposed to a brand like a Coca-Cola, which is not telling you to go and buy something from their store. It's just saying, hey, we're Coca-Cola and we're awesome.
Yeah, exactly. And there's there's a whole thing about, I guess, which is a better way to market. And generally you see brand marketing decline substantially when there's weak economic activity, because it's kind of like this extra thing that businesses do, and it's an easy spending to cut. And there's actually, it's quite challenging to kind of figure out how much that brand marketing is contributing to their revenue anyway, because if Coca-Cola spends $100 million or whatever on YouTube ads, it's not as if they can track the people who have seen that ad to see if they've gone and purchased a Coca-Cola, whereas direct response, you can kind of track that. But
that's exactly what I was going to say as well. Yeah, you definitely cut brand marketing just because you have no idea of the ROI on that brand marketing. I mean, you could guess, but if you've got a course and you're selling it through a direct response ad, then you can track those link clicks and whatever, and you do understand the ROI. So yeah, it totally makes sense that direct response is up and brand marketing is down.
Yeah. In terms of sort of how much it cost them to generate that advertising revenue, so they have a figure called traffic acquisition cost. That was 17.5% of their advertising revenue, and that was down from 18.6%. So even though revenues went down, as a percentage, it cost them less to generate that revenue. So thought that was interesting.
So that's good, yeah.
Yeah, and earnings per share came in at $10.13, was down at 29% year over year, so quite a substantial dip
Yeah, wow.
in their earnings figure. Cash flow came in at $8.6 billion. Free cash flow, that is, $8.6 billion. That was actually up 32% year over year. So
Yeah, well, that's good.
yeah, certainly positive. And during the quarter, they repurchased $6.8 billion in stock. So continuing their trend of using their huge cash pile to repurchase stock and return a bit of capital to shareholders. And speaking of that cash pile, they have $121 billion in cash and marketable securities and $4 billion in debt. So in a very similar way to what we'll see from Facebook, they're in a very, very good financial position, financial health.
Yeah. I'm just looking at this quarter. When did the last quarter start? It's March. It's April. April, May, June. Yeah. Oh, so that makes sense if they were doing a lot of. I was just looking at their stock price and saying, trying to see if it was actually smart for them to do share repurchases. And it seems like it probably was, because that's when their price hit the whatever it was, 30% drop.
Right.
Coming out of that 30% drop, they were buying back shares, 6.8 billion in the quarter. So that probably worked out pretty well for them. But yeah, far out. Google's just one of these companies, man. They're so rock solid.
It's a beast.
They're so I think I've said this before. I can't remember if we're talking about Google or another company, but it's just like, is there any stimulus, anything that could happen right now that could threaten the survival of their business? I don't think so. I don't think there is anything big enough that could put Google out of business.
Yeah, I mean, certainly from a financial health perspective, there's nothing. Something that could impact their revenue substantially. I mean, not in the I couldn't imagine anything in the short term, like nothing coming along and just wiping out the company, right? Unless they got a huge fine or something. But even that, I mean,
even that they already get huge
so
fines.
Much. They've just got so much. Yeah, they get. Yeah, we always have a joke about Google, don't we? They have about 10 billion in fines. They just ship out every single year.
Non-recurring expense.
Yeah. No, it's you couldn't imagine anything. I couldn't imagine anything just smashing their business in the short term, at least.
And you'd be able to see it coming. If they were going to get into a pickle, you'd be able to see it coming. It wouldn't happen straight away just because they're in such a rock solid position. You'd just see it. It'd take years.
Yeah, it would be a slow, gradual process of people moving to other sites, for example, or businesses not getting the returns that they want on their advertising spend, so they're going somewhere else.
Yeah.
But it wouldn't be something that would just happen really quickly. You wouldn't think
that would be the biggest threat if they had a better option for advertising. I reckon that would definitely be the biggest threat to Google's business, because if you have a better option for advertising, then you'd leave straight away.
Yeah, exactly. And I mean, the thing is, Facebook's a huge competitor, but they both offer something unique.
It's different.
Exactly. I know a lot of businesses that advertise a little bit on both, because you can do specific targeted advertising on Facebook, and then you have Google search where people are actually searching for something, and you can advertise in front of that. So there's kind of two different things, and they kind of complement themselves in a way.
Yeah.
So yeah.
Totally. Yeah. Like if you're on Google and you want to make the best ad for Google, then you that's more for instance, people typing in, best plumber in Canberra, or, roof repair Melbourne, or something like that. Then you pay to be at the top of the list kind of thing. Whereas it wouldn't really work if you're a plumber in, say, Canberra, just advertising on Facebook and trying to hit a broad people, because Facebook is like, you're targeting what are you targeting? People that have an interest in plumbing. You can't really target people that have plumbing issues, because a lot of the time people don't know they've got them until they do.
That's a good point.
So that's where Google ads work for some types of things, whereas Facebook ads are better for other types of things, which I'm sure we'll get into right about now.
Nice transition. All right. So in terms of Facebook's second quarter, so the first thing I just wanted to say was that their earnings were actually supposed to come out a day earlier, but and we would have been able to speak about it on last week's podcast, but they were actually delayed because Zuckerberg had to testify to Congress, and he was alongside Tim Cook and Jeff Bezos and Sundar Pichai.
That's the one.
So Apple, who who do we have? Apple, Facebook, Google, and Amazon, basically testifying around antitrust laws. I just pulled one thing out of this. I listened to a little bit of it, but one that I thought was interesting was they questioned Zuckerberg about the acquisition of Instagram in 2012. Basically saying that it was anti-competitive, that he was just buying out competition, and that, you know, he was kind of just sucking in a business that was a threat to Facebook. And Zuckerberg basically said that, you know, looking back in hindsight, it looks like Facebook has the ability to just buy out any competitor. But at the time, but he said that at the time, there were actually many contenders for photo-based social media apps, and it actually wasn't obvious at all that Instagram would be the winner in that space. And I think that's interesting because it is kind of easy to look back in hindsight and say, wow, they just bought Instagram, which is now, you know, the largest or the second largest social media platform. But whether that was the case back in 2012 is a different story. And certainly if there was a number of potential Instagrams, I guess, that could have blown up, then, you know, it paints a different story about whether it was anti-competitive for Facebook to buy that company. So I thought that was interesting.
Or whether, like Facebook, you could argue that Facebook's made Instagram what it is today, which is kind of true considering they bought it back in 2012. So they've had 8 years of development of that platform to make it what it is today. So it's like, it's like, think about the situation we were in back in 2012, not the situation we're in now.
I found the whole questioning thing around in Congress just very political. The questions were being asked and there was no answer. They wouldn't even give them the chance to answer, which I thought a lot of the questions were good. And I thought a lot of the time, if they had just let them answer, it still would have had the same impact. But the fact that they don't let them answer just kind of makes me immediately side with the businesses, because you have to let them answer the questions that you're asking. Otherwise, it just seems so political. You're trying to get a 2-minute kind of snippet that looks good.
It's like you're trying to soundbite them. It's like you're just asking loaded questions. It was, to be honest, I got so frustrated watching it. I've been watching the YouTube clips where it's like everything Tim Cook said to Congress, and then I watched everything Jeff Bezos said to Congress. I've been watching those, broken down like that. And it's so frustrating when you get these very busy people, these massive tech CEOs that are, let's be honest, quite busy running their own companies. You drag them into Congress and you make them answer questions. And, you know, they have so much information in their heads from running their own companies. And then you ask them a question and then you finish the question, let them talk for about 10 seconds at most,
if that.
And then you cut them off and ask them a different question. It's just horrible. I mean, watching it, it's just like, do these guys have any self-awareness? The people that are asking the questions, they spend about 30 seconds asking this long-winded question with examples, and then they let the other person talk for literally 5 or 10 seconds before cutting them off again.
And a lot of the questions are just very redundant because they're speaking to a specific example of a situation where a Google has messed up, or a situation where Facebook made a mistake, right? They deleted someone that probably shouldn't have been deleted off the platform. And Mark Zuckerberg has no idea what you're talking about.
Exactly.
It's one thing that has happened. Probably
one out of several billion things.
In the same time, 50 billion posts were probably put on the platform.
Exactly.
It just, some of the questions were just so political, and I wish they had more of a chance to respond.
It's just so infuriating, man. And I got so annoyed because some of the times the CEOs want to keep talking. So even though the politicians are trying to cut them off again, they keep talking to continue trying to explain what they're talking about. And the Congress people are just relentless. They're like, sorry, Jeff, my time is limited. I want to ask you this next question. It's like, just listen to them. Jesus Christ. Oh, man, it's seriously infuriating. If you got some time, if you got like 15 minutes, just look up on YouTube, just look up something like everything Jeff Bezos said in Congress, or everything that Tim Cook said in Congress. And it's just remarkable at what politics has come down to. It was quite sad.
Very sad.
I got frustrated. Anyway.
I did too. Don't worry. All right.
Back on to Facebook 2020 Q2 earnings.
Yes. So Facebook's revenue. So that came in at $18.7 billion, which was actually up during the quarter. So that was up 11% year over year. So that's kind of the first difference, I guess, between Google and Facebook was Google is much bigger. First of all, $38 billion, saw a 2% decline. And then Facebook at $18.7 billion, up 11%. So we had, so then we can kind of talk about what drove that increase in revenue. So the first thing is average revenue per user was $7.05, which was flat year over year. So that actually didn't increase at all. However, this number has been increasing at a huge rate over time. And I just quickly looked back a couple of years to kind of see what this figure was back 5 years ago. And in 2015, so in the second quarter of 2015, average revenue per user was just $2.70. So that's a 3 times increase in 4 years in how much revenue they're generating per user on the platform. So I think it's clear go on.
I was just going to say, and this is a combination of like more ads, higher prices for ads. Are there other factors like that? That's a remarkable increase in average revenue per user.
Yeah, I think, So, I mean, what drives this is, I guess, the engagement by users, how many ads a user, how long they're staying on the platform, how many ads they're being served. And then it really just comes down to the auction game of advertising, which I think the best way to think about it is in the same way of real estate. So think of users on the platform as the amount of real estate. So if there's more real estate, then that will put downward pressure. If there's more users, they'll put downward pressure on advertising rates for advertisers. Yeah. And then if there's more advertisers, that's kind of like more people at the auction bidding for houses. It's going to put upward pressure. So that's kind of what drives that. But
makes sense.
I think it's obvious that as their user growth slows down and reaches a peak, which we'll talk about that in just a second, the increases in revenue is going to have to come from generating more revenue out of each of the users, serving them more ads, and then encouraging more advertisers to spend more money on the platform. Yeah,
for sure. Yeah, and I guess the ball's back in Facebook's court. You've got to continue to make your ad platform more effective than everybody else's offerings so that, advertisers are willing to, go to Facebook, pay the extra money because as an advertiser, you know that your ads on Facebook are, X percent more effective than ads on Google or ads on, Amazon or something like that.
Yeah, exactly right.
Yeah.
In terms of monthly active users, so they now have this, they've done this for a couple of quarters, they now have this monthly active users figure for the family of apps. So how many people use at least one of WhatsApp, Messenger, Facebook, Instagram. I'm probably missing one in there. But then, so the monthly active users for that came in at 3.14 billion users, which was up 14% year over year. So this number, this is
a lot of people.
It's just amazing to me that they've still grown this number at almost 15% in a year, which and then in terms of over the last 3 months, so just quarter over quarter, they added 150 million monthly active users. So they're still growing, even though they have a third of the world population as a monthly active user.
It's unreal. They're going to run out of ideas. I can see in the future there's going to be Facebook launches new initiative. Now when a new baby is born, they get their weight taken, they get the doctor's check, and they get a Facebook account. It'll be like, Facebook pushes for new legislation that all newborns be given instant Facebook accounts.
No, but you've actually got a point there, because there is a minimum age for Facebook, right? So they haven't tapped into children at all. They should just have a limited version of Facebook.
Facebook for kids.
That's just you've got 0 to 13 years old or whatever the age thing is. That's it. That's another 2 billion people right there.
Yeah,
probably not.
I tell you what, a lot of advertisers would probably like that. Imagine all the toy manufacturers, skateboards, blah blah blah. That would be great.
Yeah, that's the only problem in that plan, is that it's illegal to advertise directly to children. So
is it? Okay,
it is,
I actually didn't know that. There you go.
Yeah, so
that makes sense. You wouldn't be able to monetize it very well.
Yeah. Oh dear. So advertising revenue is still most of their business, of course. It represented 98% of that total revenue figure. And that's compared to 98.4% a year ago. So it's become a slightly smaller percentage, and payments, which is the rest, has become a slightly bigger percentage, but not by much, of course. And that very, very tiny payment segment grew by 40% year over year. So, I mean, that 40% it's big, but it doesn't really mean anything because I think they did about 100, I don't know, it was in the hundreds of millions, not even in the billions of dollars yet. So,
yeah. It's like a 5-cent piece turning into a 10-cent piece.
Exactly right.
Like, cool. All right. Back to the hundreds of millions and billions of dollars that the advertising stuff makes.
In terms of their earnings per share, it came in at $1.80, which was up 98% year over year. But that number is pretty misleading because in the second quarter of 2019, which is the comparison year, those years included a $2 billion legal expense and a $1.1 billion one-time tax fee. So in other words, the comparison earnings per share was really low because of some one-time fees, and then that makes this year's look much better. But if we look at income from operations and we exclude all of those one-time fees, then their year-over-year growth was it was a decline of about 10% year over year. So, interesting swing. Their official number is 98% up, but in terms of their operations, it was negative 10%. But that's funny. That's GAAP accounting for you.
Yeah, I know, right? It just shows you how much these things can swing. That's why, when you see CNBC or whatever report all these numbers, I always make sure I go that extra step and actually check the 10Q or the earnings release from the company's investor relations page, because stuff like this can be lost in the details a little bit.
Yeah, you always have to read the footnotes, the little ones and the little twos, the little stars at the bottom of the financial reports, because there's always a lot of information in there that they don't want you to see.
And if they don't want you to see it, then they will structure it in a way that makes it very hard to see. I've got an interesting example of that coming up, actually.
Oh, okay. Interesting.
Yeah.
All right.
Hold that thought.
Yeah. All right. Well, in terms of their financial health, in a similar way to Google, it's terrific. So they have cash and marketable securities of $58 billion, $0 in debt, and their equity is at $110 billion.
Tell you what, I'd quite like to be in that position.
Yeah, it's pretty good. They had a
pretty good. I mean, that's an understatement of the century.
Yeah, it's not bad. I've seen better. No, I honestly haven't even seen better.
Could be better.
Yeah, it could be better. No, they haven't. They had a very small amount of debt very early on in their company, and then they just had none ever since. They just haven't needed it. So it's been very impressive.
Yeah. I think I looked into it, and they've got like $2 billion in a revolving credit facility, but that's it. So it's like something that you just keep open. It's like a loan that you can keep paid off, but you can withdraw it at any time if you need to. Yeah. But they don't.
It's like a credit card that you don't use. It's like it's there.
Yeah, exactly right.
You can access that money, but they don't need to.
They don't use it. Yeah. And why do they need? They don't need to. Not at all.
Yeah.
It's probably just a requirement. Just like, just make sure we've got it just in case. Yeah, just in case.
Just in case. Trying to get their credit score up because they don't have any debt.
Yeah, exactly right. We can't borrow money. It's funny.
So that was basically it. That's what I had for Facebook. Their stock was up 6% this week since their earnings. So, and prior to that, the stock's been up quite a lot, actually. I think it's at about $250 a share now. Which
it's expensive. It's right up there.
Yeah, I mean, when it was when everyone was hating on Facebook in 2018, I think it was, the stock was at 125. So exactly double now. So yeah, hindsight is good.
And it was getting pretty. I remember that time because it was getting pretty fairly priced back then.
Yeah.
It was, you could have argued that it was, for the position that they're in, they could have been fairly priced, probably at a higher share price than that. But I remember when we're running all of our calculations and whatnot, it was getting to be a pretty juicy offer at 125.
Yeah.
So,
yeah, exactly.
And clearly now, hindsight, this is a stock that's just gone bananas. But yeah, so is that all we got to talk about for Facebook?
Yeah, that's it. Yeah, where should we move next?
We'll just launch into the next big dog and talk about Apple, hey?
All right.
All right, Apple earnings, Q3 earnings, very confusing. Please standardize that system. It annoys the hell out of me. Apple, come on, slap on the wrist.
Come on, Timmy.
So what have Apple got? Revenue of $59.7 billion in the quarter, up year over year from 53.8. So it's an 11% year on year increase. So yeah, pretty interesting. I mean, I probably wouldn't have expected that. I guess there's a case for expecting it and not expecting it, but I wouldn't have expected it just because, unemployment, tightening up of spending. I mean, Apple is known to be very expensive for the technology that they offer. Yeah. There's obviously the running joke of the Apple logo on your product costing several hundreds of dollars. But very interesting. They still had an 11% year-on-year increase in their revenue. Out of that revenue, 77% was from their products, 23% from their services. Last year, that split was about the same. So 78% products, 22% services. Right. Still even spread of revenue generation. They also had an 11% increase in revenue. They had a 12% increase in net income. So interesting that the growth on the top line is kind of matching the bottom line as well.
Yeah, they're not even getting less efficient or anything.
And then
like
when
that.
you actually look into the splits, when we go into their products, they're actually getting growth out of all product categories. So of course, iPhone's their biggest, but iPhone sales only grew 1.6% year over year. Mac, big increase in Mac, 21.6% growth year over year. And I think that's just because there's been such this year, you know how they do these like yearly refreshes of their Mac books and whatnot. I think this year there's just been really positive reviews. At least I've seen a hell of a lot of positive reviews. I mean, I've bought a new MacBook in the last year.
That's crazy.
And Mac Pro obviously got its big release last year as well.
Yeah, it's crazy to see that it's gone up so much. I mean, it's certainly discretionary spending. So you wouldn't expect. Yeah, for sure. I would not have imagined that you would see increases in iPhones, particularly Macs. So by that much, it's crazy.
Yep. We've also got 31% growth in iPad sales, 17% growth in wearables. Wearables, accessories, and other. So it's like the Apple Watch and the earphones and all the dongles and whatever. This category of their revenue just really frustrates me because it annoys me that they just try and squeeze their customers for as much money. Like, I know they're a business. Like, come on, they're trying to make money, but the levels that they're going to try and squeeze money out of their customers is just ridiculous. Like, I got infuriated enough back when they brought in all the different dongles. It's like, no, the only ports on our products are now going to be like USB-C, and now you've just got to get dongles if you want HDMI or old USB or whatever it is that you want. I mean, that annoyed me enough, but now there's rumors going around at the moment, and this really frustrated me, that the next generation iPhone 12, will ship without headphones and without a charger.
Without a charger, that seems
Have
ridiculous.
you heard this?
I have. And I've heard a counter argument to this, that there are a lot of people who buy the new iPhone have had previous Apple products. They have chargers, they have headphones, and they just throw them out, and they become a substantial amount of a contributor to just waste in the environment.
Yeah.
But that being said, it's insane to ship a device that you can't use out of the box for more than 20 minutes before it dies. That's ridiculous.
Surely you have to ship it with a charger. Seriously.
Yeah, and
but you know what the thing is. They say this is to help it become more cost effective. iPhone 12 is not going to be cheaper than iPhone 11.
Yeah,
that's not going to happen.
You couldn't imagine it. Yeah, so I would be okay with this if you can buy, if say you go onto the Apple website and you go to buy the iPhone 12. If it is the price for the headphones and the charger, if the difference is taken out of the price and then you can just add them as a bundle to get to the same price as the previous iPhone, then that's fine. Yeah. But that's not going to be the case.
That's not going to happen. That's not going to happen.
I don't know. It'd actually be interesting because they've been increasing phones across the board have been increasing their prices substantially over the past few years. I wonder if they'll be able to do that going into this year, considering the economic condition we're in.
Yeah, it's true.
I'll be interested because we've seen $100, $200, $300 increases over a year in some cases, where prices basically accelerated from $1,000 a phone for the top end phone to $2,000 for the top end phone. But yeah, it'll be interesting to see what they do.
Yeah, I'm looking here, just trying to see whether it's likely that Apple are going to keep their prices down. I don't think it is. I'm looking at on their website, a USB-C power adapter. Guess how much it costs?
USB-C power adapter.
Yeah, just like the power adapter that you stick into the wall.
I don't know, $20?
$99. Bastards. All right, how about this? It's a USB-C dongle that, what's it got on the end of it? It's got a USB-C, a USB, I don't know, what's the old one called?
I don't know.
The old, it's got a USB-C, an old USB, and a HDMI port. Guess how much that? So it turns
for a Mac,
one
right?
USB-C into USB-C, USB, and HDMI. Guess how much?
For a Mac?
Yeah.
I don't know, $50?
$99. This is bonkers. This is ridiculous.
And you know the margin on that's like 90%.
Yeah, exactly right. So, when you say, I would be okay with this if, if they figured it out and they offered it cheaper as the phone, and then if you bought the dongle and if you bought the charger and the headphones, it brings it up to the price it was before. But it just seems unlikely, doesn't it?
I don't think so.
No. Anyway. All right, let's keep moving on. So, this is when I told you to hold that thought from before. What were we talking about? Something about companies trying to hide details.
Yes.
Yeah. I'm not sure if this is legal, but clearly it is, because I can't imagine they've broken the SEC's laws for reporting. But in a 10Q, when it comes to your cash flow statement, I would imagine you have to give the cash flow numbers for the quarter, for the 3 months, the previous 3 months, in a 10Q. However, I looked through Apple's 10Q, the one they've just released for their Q3 earnings, and the only cash flow data they give is for 9 months ended.
Yeah, that's really frustrating. I've seen that with a number of companies. I see. So in their press release, sometimes they'll talk quarterly. And then in the actual 10Q, I've seen this with some do just show the quarterly, which is insane to think that they don't show the quarterly data for the quarterly financial results. I mean,
it doesn't make sense.
You can work it out, obviously. Like you can work it out from the second quarter and the first quarter. You just subtract them. But to not include it, it does seem weird.
I mean, it's just a workaround. It's just frustrating, isn't it?
Yeah.
Like I'm looking at all these. I was looking at the income statement, then I flipped over to the cash flow statement. All of a sudden, these numbers were enormous, and I was like, "Wait, what? They're like triple." And I'm like, "Oh, they're only giving us 9 months ended." So anyway, it just makes me suspicious. It's like, you trying to hide something or what? But I find it so bizarre that you don't have to report the quarterly cash flow numbers in your 10Q. For that quarter. Anyway, whatever, is what it is. So anyway, for free cash flow for the 9 months ended to this quarter, 54.6 billion in this 9 months versus last year's 9 months of 41.8 billion. So that's up 30%. So there's still a cash flow beast. Still making a lot of money. Also, $55 billion in stock repurchases over the last 9 months, while the stock's risen almost 100% in that time, now up to $440 a share.
Wow.
So there is that.
That's interesting. So they repurchased, so they basically had free cash flow of 55. They repurchased 55, and then I presume they paid some dividends as well on top of that. So
yeah, probably. So they just in give it back to the shareholders mode.
Yeah,
aren't they?
exactly. Just deliver as much as possible. Yeah.
Anyway, balance sheet numbers: 33 billion in cash, 53 billion in short-term marketable securities. So very much so cashed up. They got 100 billion in term debt in total, of which 7.5 billion is hitting in the next 12 months. 140 billion in current assets, 95 billion in current liabilities. So that's positive. 72 billion in equity. So they're in good shape, but I've written here I still remain disappointed because I just when I say Apple, I want to think innovation, the best technology products, pushing the limits, making new products out of thin air. But that's just not really happening anymore.
No, it hasn't. And it hasn't happened for a while. So,
no.
It's just I will be very curious to see. I mean, take the smartphone industry for a while. It's been quite a while since there's been a substantial innovation, I think, in the phone space. So I'm very interested to see over the next 5 years or so if it's Apple that hits the nail on the head again with some new device that, takes its place in the market that doesn't exist already, or an innovation in an existing product, or whether it's a new company that comes along and starts to take some customers away from that space. But it'll be...
It seems from just listening to Elon Musk and that sort of stuff, it seems like the next level from smartphone is Neuralink. It's basically taking the smartphone from a physical device that you interact with your hands and put in your pocket to putting the entire interface inside your brain. It seems like it's the next jump. And this is what it sounds bonkers, but this is actually real.
Yeah.
Well, it's not, it's being built at the moment. Because it makes logical sense. I mean, the problem we have, Elon's always saying we're already a cyborg because we're so reliant on our phones. We take it everywhere. We're remarkably smarter when we've got our phones because we can just look anything we need to up. We know exactly where we're going. We can open maps, blah, blah, blah. So the next step is just putting that functionality in a device which directly interacts with your brain. Because at the moment, to get the information out of our phone, we use our two thumbs and we punch letters. It's like typing on a keyboard, but only using your thumbs. It's incredibly slow. So the next step is to put it in your brain and teach your brain to interact with it. So you could imagine that literally like Google searching from inside your own brain.
Look, if humans get overrun by AI, if we get, I guess, displaced by AI, it's our own fault because we built it and now we're going to put it in our head. So
yeah, exactly.
We put it in there. So if it takes over, it's certainly a fascinating topic. Go check out. I think I'm not sure where else Elon's spoken about this, but on both Joe Rogan podcasts, they're great for getting a bit of a deeper understanding about. That's where I got my understanding of Neuralink. Fascinating stuff.
Yeah, the most recent Joe Rogan podcast, he really went into Neuralink. It's so interesting, and it's going to have some great applications too. So it's very interesting to learn about it. Anyway, let's move on from Apple. That's all I've got to talk about for Apple. The 4-for-1 stock split's coming as well.
Yeah.
Maybe just very quickly, I'll get through Ford. Ford's interesting because I was reading the headlines, and the headline here is Ford earnings were way, way, way better than feared.
Who wrote that article? A big shareholder in Ford, that's for sure.
Yeah, definitely. It's from Barron's, so I don't know.
Okay. Yeah, big stake in Ford, I bet.
Yeah, probably. It says here, things as they turned out were nowhere near as bad as feared.
Wow.
Ford stock, as a result, is up 4.3% in after-hours trading, bringing relief for some long-suffering automotive investors. But then you look at their results. Revenue, $19.3 billion versus $38.8 billion last year. So revenue's taken a hit. They made an operating loss of $2.7 billion, free cash flow negative $3.8 billion. They've managed in the first half of this year to raise $44 billion in debt. So, but don't worry, Ford earnings are way, way, way better than first feared.
$44 billion in debt. Oh my God, I've been on the wrong train. I've been looking at Netflix.
That's a lot.
I need to get on the Ford earnings train.
Yeah, exactly right. Yeah, it's pretty insane. Balance sheet wise, $31 billion in cash, $26 billion in marketable securities, $124 billion in current assets, and $92 billion in current liabilities. So it doesn't look too bad. Automotive debt, they've got $39.4 billion in automotive debt, and then the other debt is to do with Ford credit. But I'm not super into exactly how Ford works. But I was just having a kind of a quick flick through. One thing that did stand out to me is that it said that after being idled for 6 weeks, the plants in North America smoothly resumed operations and ended the quarter at about 95% of their pre-pandemic production levels. So that's promising if you're someone that follows Ford.
Right. So the last 6 weeks, there were
No,
sorry, idle for 6 weeks.
Sorry. Yeah, they were idle for 6 weeks, and now in the quarter they've resumed up to 95% of their pre-pandemic production levels.
Okay, that's good.
Yeah,
well, they're getting production back up there now. It's just a matter of whether the demand is there.
Yeah, exactly. Interestingly, though, they did note on that they have kind of increased their market share in a couple of different things. They said retail share for F Series was up 2.5 percentage points to more than 33%, just months ahead of the production launch of the all-new 2021 version of the F-150, which is America's top-selling truck for 38 years straight. Wow. Which is pretty interesting. And this perked my ears up because I'm super interested to see how the Cybertruck's going to stack up against something like the F-150, because at the end of the day, they are the same product. They are a pickup truck, although they're probably going to be marketed to different consumers, different people. Just because the Cybertruck is just so different. It doesn't really feel like you're buying a pickup truck, I suppose.
Yeah, I mean, it's certainly different. That's one way to describe it.
It's certainly different. Yeah, but I really want to see, I'm going to be so interested to see how the Cybertruck sells in comparison to the F-150, because at the moment, Cybertruck already is still like 2 years away from production. It's already got 500,000 pre-orders. Oh. Which is promising. But then on the other hand, Ford sells, I think, 900,000 F-150s each year. Wow. Which is a lot of cars.
It's a lot of cars.
So, yeah, I'm just super interested to see how that number gets impacted when the Cybertruck comes out. You know, are Ford able to maintain this lead in pickup trucks? Do people turn towards the electric pickup truck? Because on paper, like, the Cybertruck just beats the performance of the F-150 in basically every category. But then again, it looks so radically different. It's kind of for a different person. So I don't know. Interesting. Yeah.
Yeah. Guess we'll see what happens. All right. Should we move into some Q&A to finish up this week's podcast?
Yeah. Let's do it.
Yeah, so I'll pose this question. We've only got one question that came in recently, so I'll pose it to you. The question is, I was interested to hear you talk about Visa. They seem like a great company to invest in, but according to my calculations, they are extremely overvalued at the moment. My question is, what margin of safety percentage do you usually aim for? And for a great company like Visa, who has great financials and are unlikely to have a big drop in their share price, would you ever reduce your margin of safety down to 20%, for example, from 50%?
Yeah, well, definitely when I was learning to invest, it was always, aim for that 50%, aim for that 50% margin of safety. And the reason the margin of safety is even a thing is because when we do all of our valuations, we're always trying to estimate, we're trying to guess out into the future as to what's going to happen. And because the future hasn't happened yet, like, there's going to be some level of error. So the margin of safety is all about accounting for the inevitable errors that you've made in trying to guess what's going to happen in the future. And it's very true. Yes, Visa. Yes, Facebook, Apple, like, basically every big company you look at the moment, you're going to come out with a share price that's extremely overvalued. And that's just the nature of this market at the moment because it's so overvalued. So I try and stay true to that 50%, but obviously at the moment, 50% is pretty unrealistic in most cases. So I try and go at least 30, at least 30% margin of safety. And I've been, like, strictly, I'd love just to be 50%. But at the moment, what I'm doing is because I'm earning money and, I don't want to keep so much of my money on the sidelines. I want to have more money in the market. I've got enough cash on the sidelines to protect me if the market goes down and I can take advantage of that. So I want to try and find places to put my money where I still can get a return, even if it's not going to be the best return I've ever gotten. But that's why but I still think you should probably aim to get at least 30%. What do you think?
Yeah, no, exactly right. I think if I have too much, the only situation in which I'm dropping that margin of safety is usually if I have too much cash and there's just no other better opportunity. So I want to put money in the market, but there's just nothing at a margin of safety price. I have too much cash, so maybe I'm willing to have a little bit of wiggle room. But you certainly need at least some level of margin of safety, because it's not even just about how much you know about a business. So some people kind of say, and I know that I've said this in the past, that if I'm more confident on an investment, then I will lower the margin of safety. But there's a certain point to which you just still need that margin of safety. There's still things that you cannot know are coming down the road. And as a result, even if you are completely confident on an investment, you've done hours and hundreds of hours of analysis on it or something like that, you would still want a margin of safety to just make sure that you make that return, even if some big event happens that you weren't expecting in the industry or to the business specifically, or to the global economy.
Yeah. Yeah, that's it. All right. Should we move on to this next one?
Yeah, sure.
Yeah. So this one is an interesting kind of discussion topic about Tesla. Have you guys considered what would happen if Tesla, instead of allowing their car owners to use their cars in the robo-taxi network, instead they just produce cars exclusively for the robo-taxi network, and Tesla just owns them, and then they end up making their cars compete with your car in the robo-taxi network, because obviously they own the system, and if it's beneficial for them to run their own cars in their own system and not cut you in, then they might do that. So what do you think about that? Does that kind of alter your opinion on it? Yeah. It does, to an extent, because it makes sense, doesn't it?
Yeah, I mean, it's certainly something that could happen. And when we're talking about, we might be able to get 30,000 out of this car, and how I was talking about how it's kind of the same economics as investing in a property. You get a car loan and that sort of thing. I mean, we're just purely speculating. Like, we have no idea what the landscape's going to look like, right? We don't know if Tesla's going to.
It's our best guess.
Yeah, we don't know if Tesla is going to allow people to do that, or what competition even Tesla will have when this is possible. Because to have a situation where you can just have a pure robo-taxi where a car just comes and picks you up and there's nobody in the car and you just get in, that's still a while away, I would say, in terms of government regulation. That's going to be a while away. So Tesla will probably have some competition at that point, and what this entire landscape will look like is a complete unknown. So what you've described there is, I think, there's a very good possibility that that's something that happens. That's something that either Tesla does, or another business that also has autonomous cars does that. So yeah, what do you think, Brandon?
Yeah, there's certainly an element of unpredictability, because we just don't know what is going to happen in the future. But the thing I'd say is that Elon, he always does right by the people that own their Teslas, and he's come out and said confidently that yes, you'll be able to, as an owner, connect your car to the robo-taxi network, and you'll be able to make money, passive income from your car. And he said that as a draw card for people to buy a Tesla. So from my perspective, yes, because it hasn't happened yet, he could just go, actually, we haven't made any of the rules yet, so we're changing the rules, and now it's only Tesla-owned cars can operate in the network. But I think that because Elon, obviously his reputation's on the line, and he tends to always do right by the owners of his cars. So I think that he will definitely allow people to connect their own cars to the network, even if it costs Tesla a little bit of money. And he'll still make sure that, it will be profitable for you to run your car in the Tesla network, and you'll be able to make a healthy amount of money. That's my opinion, just because of what he's said in the past and how he typically acts for, people that own the cars.
Yeah. All right. Should we leave the podcast there for today?
Yeah, I think so. That's probably gone long enough. We did get through a lot, didn't we?
We did. We had a lot to talk about. And as always, if you have companies that you want us to have a look into next week, then make sure you head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Just click on the latest podcast episode and let us know what companies you want us to talk about next week. And also, if you have any questions or any comments or feedback or anything you want to share, you can also leave that there. Thanks, awesome. Sharesight, for sponsoring us this week. And thanks, Brandon, for joining us as always.
It's all right. Thanks for having me on.
All right.
It's been good. And I guess we'll see you guys next week.
See you guys.